going to talk about investing in the UK in a post-Brexit world, but also about Arca and the specific place we hold in the market in the UK. Okay, so Arca helps clients to protect capital values and enhance returns throughout the property cycle. We're pioneers of short-term property market risk management. We're regulated by the FCA and RICS. The product that we broker effectively is CFTC approved, so US investors can trade it. We've got over 20 years experience trading or brokering financial products linked to the performance of real estate, and we've done over 3 billion sterling in transactions. Okay, so just to start, given its topicality, I just wanted to say the case for the UK investment market, for property investment market post-Brexit. Obviously, sterling is cheaper. It's more attractive relative to equities and bonds. Now, the reason for that being equities are very volatile at the moment and will continue to be so. The bond markets, obviously, rates have gone down, so the spread between bonds and property has become more attractive. If you think the problems in the UK are bad or look bad, the problems in Europe are just beginning. So UK might look more attractive relative to mainland Europe over the next 18 months. You've got French elections next year, you've got German elections next year, you've got a Greek bailout coming up, and I think there's Spanish elections coming up soon as well. So there's all sorts of things on the horizon. And Pieter, I know you were talking about accelerated integration, but I find that difficult to believe with France at the moment, given their political climate and their election next year. But things are moving quickly, and I guess no one really knows at this point. The long-term benefits of UK investment in real estate haven't gone away. It's a safe, secure market, and it will continue to be so. So people might find right now it's with pricing, they can be opportunistic, they can put in cheeky bids, and with the currency, it might be an attractive investment right now. So just quickly, why trade IPD futures? And this is a unique access point to the market. Essentially, we'll talk about the characteristics of the product, but in terms of why you use the product, well, it's flexible relative to the direct investment market. When you trade a future, you're trading a one-year contract, so you're only taking an investment time frame of 1 calendar year, but you can go out up to 5 discrete calendar years into the future. Speed of transaction, obviously, once you give your order, the transaction can execute instantaneously or the next day or within a couple of weeks, depending on the size and complexity. You get guaranteed cash at maturity. When the contract settles within the year, you get guaranteed cash, and that's obviously a great liquidity bonus that other property products on the market don't give you necessarily. There's daily pricing. You're constantly aware of where the contract is priced, and that's great for risk management as well. Relative to the direct market, it's very cheap to trade. You're looking at less than 50 basis points for the round trip. Obviously, UK real estate's got 1% more expensive this year in March, courtesy of the Chancellor. So you're looking at about a round trip 8% for the direct real estate. Given the way futures trade, if you did a 100 million trade, you're only obligated to put down 6% in initial margin. So effectively, you've got 94% free gearing if you are able to use gearing. A lot of pension funds obviously don't, but hedge funds do, and that's a very attractive quality on the product. It's fully regulatory compliant. As I said, you've got the guaranteed annual liquidity, virtually no counterparty risk, the way it trades through the exchange and goes through a CCP clearing mechanism. There are no setup costs, just costs you your time and due diligence. You pay as you trade, and this is not just about buying exposure into the market, but you can also sell exposure, so you can hedge as well. Okay, so just to sort of try and put this in the place of the investment universe, let's look at the direct market first and see the characteristics of a sort of investment into UK direct assets. It's a mid to long term capital tie-up. You're looking at 5 to 7 years average nowadays in terms of hold period. You're taking on asset-specific risk, which can lead to alpha, obviously. You've got high cost to trade. We've talked about that, 8% round-trip cost. Long time lags. Obviously, it takes a long time to negotiate and secure deals through the bidding process. There's has been a lack of supply that questionably, since Brexit, may increase availability of deal flow. But within the individual assets, obviously, you've got tenant-specific risk and all the sort of labour and time intensity to work that asset. By comparison, the characteristics of the futures, it's a short-term trade. You're looking at just the front 2 years of that investment, if you like, the first two cash flows of that building. You've got the ability not just to buy, but also to sell. So that makes it a risk management tool or portfolio risk management tool, not just an investment product. It's quick and easy to execute, and it's complementary to your portfolio, not competitive. So look at ways in which you can use it to enhance your portfolio returns, not as a competitive product to the direct. And the analogy or concept I like to use is your direct portfolio moves very much like an oil tanker. It's difficult to maneuver, and the futures, if you like, are the speedboat around the edge. So it's quick to maneuver, it's obviously smaller size, but you're able to do things in the short term, and you've got the flexibility. Okay, so just drilling a bit deeper into the characteristics of the futures contracts. Well, they're traded on the Eurex exchange, which is, I guess, Europe's equivalent of the CME. They're based on at the moment, all the UK IPD indices, so you can trade all property, all retail, all industrial, all offices, and then you can drill down to the segment level, city offices, West End offices, shopping centres, industrial southeast, retail warehouses. So it's very granular. Contract periods are for 1 calendar year, discrete calendar year, January to December. So you're trading the performance movement of the index from the beginning of the year to the end of the year. And you can trade out to 5 discrete calendar years. So it's not just 1 year. The contracts settle the following February when IPD compute the number, and they're cash settled immediately. Each contract has a nominal size of 50,000, so the range of clients we have trading range from high net worth individuals to pension funds, family offices, property unit trusts, PAFs, hedge funds, private equity, and insurance for Solvency II purposes to mitigate their risk and therefore not have to put up regulatory capital against their positions. So in terms of the UK investment market, I just wanted to sort of talk through the environment, if you like, looking back historically at time series data since 1947, using IPD from 1981 onwards, or 1971 actually, and the Paul Scott's data, or Peter Scott's data from 1947, post Second World War. So if you look at this chart, essentially what you see is the total return in blue, which is obviously capital return plus income return over that time duration. And the capital return, you can see, has a high correlation with that chart. The difference being the sort of 6% income return. But the point I want to make here is there's not a lot of volatility around the income return in the IPD indices. That being because it's obviously a diversified portfolio of assets, and a lot of those leases are institutional grade. Obviously, even in the crisis, you know, clients were locked in 10 years upwards only rent contracts or leases. So, you know, I think we'll look at the stats regarding standard deviation and average mean returns, but you can see it's relatively static, whereas the capital return on an annual basis is much more volatile, and that's really what you're trading, you know, the volatility around capital returns. So, as I said, we break the analysis down. You can see the minimum over that time period of income returns was 3.9%, the maximum 9.8%, both being outliers. The mean average was 6.6%, with a 1% standard deviation. And that just highlights the static nature of the income return. Whereas by comparison, the capital return has been a lot more volatile. You've had a minimum of minus 26.3% in the worst year, a maximum of 23.6% in its best year, and these are all ungeared returns, by the way, and a mean average of 4.4% on an annual basis with a standard deviation of 9.8%, so nearly 10% standard deviation, which just shows the volatile nature of the capital return element of the total return. So one of the things you know, I want to demonstrate with the futures product is, obviously you have a cycle in real estate. You've got peaks and troughs. You've got periods in the cycle where you want to put risk on, and periods in the cycle where you want to take risk off. Now, the period, the up part of the cycle, as we all know, is generally a lot longer than the downturn, which can be sharp and severe in most instances when it does correct. So the point being, as we start a new cycle, when one does, one looks at building up assets, direct assets, and building their portfolios. And then as you get to, you know, when the market is by property measures fundamentally overvalued, I'm not saying once it hits that level that it's going to come off, because generally it can remain in sort of bubble territory for up to 5 years, traditionally, if you look back at the data. So, you know, at that point, one might want to start sort of taking risk off rather than buying a 7-year hold on an asset. So the futures give you that ability to start sort of locking in value at the top of the cycle when prices are, or valuations are toppy. But obviously you don't want to miss out on the last 2 years of a cycle and meet the fate of Tony Dye, like he did when he called the market back in the late 90s for the dot-com boom, but obviously called it too early and ended up losing his job. Likewise, though, if you sell futures at the end to basically lock in value, protect your assets in terms of capital values, you don't have to sell those assets through the downwards part of the cycle. You can hold on to them, keep their income returns, and your capital is effectively protected. So you'd be selling up around here, and then obviously at the beginning of the cycle, you'd go back into risk on mode and buy mode. Okay, so looking at a couple of trades. We had a pre-Brexit trade that we were looking at with clients, but it's actually relevant now because it's a market risk neutral trade. So with all the volatility around the market, it still holds actually as a good trade to do. And it obviously has good risk adjusted returns as well. The second case study is essentially an event-driven trade, and you know, one might see now as an opportunistic time to trade. So we'll look at what you may or may not be able to do, but by looking at what a client did after the general election in the UK in May last year, by way of example. Okay, so the first case study is essentially what we call a switch. So client is selling one segment and buying another. And essentially this trade was done in September 2015, and they were trading the last sort of 3-4 months of calendar 15, but they wanted to essentially buy industrials and sell shopping centres. So as you can see, the price for industrials at that point in time was 15.5%. The price for shopping centres 9.5%. That's where they traded with a 6% spread between the two. So essentially, if that spread widened, they'd make money. If it decreased, they'd obviously lose money over that time period. And this demonstrates the levels at which, when they traded in September, those markets were priced at. The red is the shopping centre price, the blue is the industrial. And as you can see, there's a 6% spread between those. In reality, when the indices settled, the industrial futures contract settled at 16.8%, which gave them a positive cash flow of 320,000. The shopping centre future settled at 10%, which gave them a negative 136,250 cash flow, given that they had sold exposure there. But the net position was 183,000 in the money, which was an annualized return of 1.3%. So, you know, over a 3-month trade, you're not dealing in big cash flows necessarily, but I think the takeaway here is that it's a good risk-adjusted returns way to trade when the market is volatile. You can process money into the market, you've got one leg long, one leg short, and essentially, regardless of the market volatility, you're still processing money into the market and you're still protected to a certain extent. Obviously, if the market crashes, you're outperforming. If the market shoots up, you've got a drag with your short side of the trade, but from a risk-adjusted returns basis, you've done well. And your market risk neutral during a time of volatility. Okay, so moving on to the second trade, which is the post-general election trade. So this was May 2015, the day after the general election. The political risk was off the table in terms of the change in tax regime on real estate. A nimble property hedge fund came to us and said, right, I want to buy the rest of calendar 2015. I want to buy the whole of calendar 2016. I want to sell calendar 2017, sell calendar 2018, and sell calendar 2019 in £60 million. A week later, we matched those trades. It was the first fund back into the UK real estate market after the general election. From strategy definition to execution was 1 week, and that was a trade of 60 million. So he traded from May last year to the end of the year. He effectively bought at 10.75%. It settled at 13.25%. Clearly, you'd already had IPD year to date, so there was a certain amount of certainty about what returns had already been delivered. He wasn't shooting in the dark, and given the uncertainty over the election had passed, he was able to sort of make a decision based on where the current trade price was, as to whether he felt there was value in that trade or not, given where he felt the market was going to settle 6 months later. So he bought that year, settled at 13.25%. He put his 6% down on that 60 million, so he made a good ROI on his capital. The second year, i.e. this year, he bought at 6.5%. We're currently priced around that level, although obviously there's we need to see comparable evidence in the market to see where the real market is now post-Brexit. There's still a bit of debate around that. And he sold the following 3 calendar years at 5.75%. So essentially he's well placed if there's a sort of fallout over those calendar years. And this is dynamic. His view here when he did the trade might have changed now because of the Brexit vote. you might think this year is going to be a positive year because there'll be potentially a Brexit bounce. And if that's the case, he can close out this trade and just keep those 2 trades on the short side for the following 2 years. So the product demonstrates flexibility, I hope. It's not just about buying and holding for 5 to 7 years. It's about taking a more dynamic approach to your investment portfolio and incorporating a certain amount of risk management in that portfolio. Or market risk management, I should say. So just in terms of the benefits for US investors, this product is CFTC approved, i.e. the Futures Trading Commission and the US have given it the thumbs up, so you can invest in it. We can't actually market from London, so we can't cold call anyone, which is why we're here, effectively. You can call us if you know about the product and want to know more, so please, if you do want to have a further discussion at any time, do please get in touch with us. And that's just the marketing laws from the US. We're just not allowed to cold call from London. If you wanted to invest in the UK, obviously you don't have to set up an office in London, you don't need to find a JV partner, you can trade immediately, quickly and efficiently and benefit from the bounce if you think there will be a Brexit bounce. Or indeed, if you have assets over in London and you're worried about them over the next 3 years, you could look to set up a hedging strategy as well. All depends on your view of the market and where the market's currently trading. The key there is that you can trade at discrete calendar years over the next 5 years. So you don't have to just go long for 7 years. You could be long or short in various different years, or roll out of 1 year and into another. And that's one of the key differences between the direct market. Okay, thank you.
Thanks very much.
Great, thanks very much, Charles. Has anybody done any deals around Brexit yet? Have you had calls on that?
Thank you. So we've had discussions with several interested counterparties. We haven't traded yet, but I think, like last year, we saw a drought in terms of deals prior to the general election. Then immediately after the election, the year effectively started because the uncertainty around the government had gone. I think we're going to see the same this year. We've had a drought in the direct and our market because investment committees haven't been committing to any deals. But now the uncertainty of the elections passed, people have got to make the decision. Do we just sit there and do nothing for however long, who knows, or do we just get on and business as usual? I think it would be more likely the latter. People, now that the votes happened and there's a changing landscape, things are changing quickly. There are lots of opportunities, there's also a lot of risk, but people need to do deals, otherwise they're not going to have jobs.